Thank you. Good morning, everybody, and welcome to our webinar titled Global Crypto Impacts in Latin America and the Caribbean, Opportunities and Risks. I'm Inigo Benguechea, and I'm the Senior Director of Government and Regulatory Relations at CFA Institute. Today we have a wonderful program for you with three fantastic speakers to discuss cryptocurrencies and their underlying technology. My congratulations to our 13 societies in Latin America and the Caribbean for putting this program together. It's been more than a decade since Bitcoin, blockchain, and cryptocurrencies exploded onto the world stage. And in that time, the crypto market has gone through the usual phases of a disruptive technology. Impressive bull markets and pullbacks, times of euphoria and moments of despair, and everything in between. And as the crypto market continues its development, one thing is clear. That is that crypto and blockchains are here to stay. Despite all the excitement, however, significant challenges remain for investors to approach in this space. And for starters, we have issues around information, security, volatility, and market efficiency. Only a few people seem to understand what crypto really means and why it should matter. Is it an alternative currency? Is it a technology? Is it a bubble? So with these questions, we thought it was the right time to dive into this space for the region, especially knowing that professional investors see the returns and local relations of crypto assets, such as Bitcoin at this point, that are becoming very hard to ignore those benefits. So for today, as a result of our efforts, we have put together this program with three speakers, and I'm going to introduce each of them. Matthew Hogan is the Chief Investment Officer at Bitwise Asset Management. He's one of the world's leading experts on crypto, ETFs, and financial technology. He was the CEO of ETF.com and Inside ETFs, where he helped build the world's first ETF data analytics system, the leading ETF media site, and the world's largest ETF conference. Matthew is also the author of a brief titled Crypto Assets, the Guide to Bitcoin, Blockchain, and Cryptocurrency for Investment Professionals. This brief is available for free at the CFA Institute website. It has had more than 70,000 downloads. Matthew, welcome. Also today, I'm pleased to introduce you to Jason Guthrie. He's the head of digital assets at Wisdom Tree Investments. He holds a Bachelor of Commerce from Macquarie University in Sydney. Prior to joining Wisdom Tree, Jason worked at Deutsche Bank's ETF Capital Markets Group, as well as Macquarie Banks as an investment executive based in Sydney, Australia. Welcome, Jason. And also with us, I'm pleased to introduce you to Matthew Siegel. He's head of digital assets at Van Eck. He's a CFA charter holder, has a BA from Harvard University. He joined Van Eck in 2021, and prior to Van Eck, he worked at Credit Lyonnais, where he spent 10 years in sales research roles, and most recently as a portfolio strategist. And prior to Van Eck, he also worked at Alliance and Bernstein. Welcome, Matthew. And finally, I'm also pleased to introduce you to our moderator for today, who is Melvin Escudero. He's the chair of the Advocacy Council for Latin America and the Caribbean, and he's also the founder and CEO of El Dorado Asset Management. Welcome to all of you, and Melvin, the floor is yours.
Thank you very much, Inigo. Actually, the new normal after the pandemic COVID-19, it's been very volatile. No? Many things are happening. Uncertainty is growing up. Never rest. And the crypto asset has basically disrupted global asset markets. There are big questionings from traditional especially regulatory agencies or government representatives about the future of the assets. Central bank governors, the securities market regulator has pushed a big questioning regarding the asset class and the different products that right now is in the initial development of what is the cryptocurrency market and the DeFi industry. But this is very similar, I think, to the era when the internet was introduced, like 30 years ago. And many people didn't believe on online commerce, for example. And right now, some of these companies are the largest market cap listed in public markets. So things change fast, and probably we are in the era of a new financial architecturing, a new remodeling or the architecture for the next, I don't know, century maybe. So we will start with the keynote presentation. Each of our guests will have around 15 minutes, not more than that, to introduce their main topics, thoughts, ideas, proposals about crypto investing, DeFi impact. So we will start first with Matthew Hogan from Bitwise. Go ahead, Matt.
Oh, thank you so much, Melvin. Thank you as well, Inigo, and thanks to everyone for joining us today. This is really exciting. I'm going to share my screen here, so if you just give me one moment. Really excited to be here and really excited to get started. Hold on one second. Great. All right, hopefully everyone is seeing that. What is crypto really? I had the unique pleasure of getting the chance to speak first. And so I'm going to start at the very basics. A few things that Inigo and Melvin said really resonated with me. One thing Inigo said is there is not a generalized understanding of what crypto is. What is a blockchain? Why does it matter? Is it a currency? Is it a technology? People talk about crypto a great deal, but I think a lot of people talk over crypto without understanding what is the fundamental technological breakthrough that has so many people excited. And Melvin mentioned that this is similar to the early days of the internet and that it could re-architect the financial ecosystem for the next century. And I love that framing, Melvin. I think that's exactly right. So what I want to do with my 10 or 15 minutes is really lay the foundation, talk about what crypto is, what it isn't, and why crypto assets have value. And then the other esteemed panelists will talk about some of the investment opportunities and investment approaches that are out there. I want to start with this slide. The original sin of crypto was that it was labeled as cryptocurrency. I know a lot of people out there are very skeptical of crypto. People think it is a bubble. People think it is akin to tulip bulbs. People think it is going to go away. And the primary reason for that, from my perspective, is that people think about it as a currency. They think about it here in the United States, where I'm from, as a competitor to the dollar. And in the US, that doesn't make sense. It doesn't add up. There are very few people out there who are using crypto today in the same way we use traditional fiat currencies. I live in the San Francisco Bay Area, one of the most tech-forward locations in the world. I work for one of the largest crypto asset managers in the world, and I have never used Bitcoin to buy a coffee at Starbucks or at my local coffee store. Crypto, despite being labeled cryptocurrency, is not really a direct competitor to traditional fiat currencies, at least not today. And that's not why some of the most smartest investors, smartest engineers, and smartest venture capitalists are moving into the space. So if you remember one thing from my 12 minutes, remember this slide. Bitcoin is not about a new way to buy coffee. So what is it? Bitcoin is a technology that, in my view, brings money into the internet era. As Melvin said, it's a technology that I believe will re-architect the financial landscape. And this slide has a very simple demonstration about what crypto does. You can see on the left sort of the way the traditional financial ecosystem works today. I'll send you a check or a bank wire from my bank. My bank will check with your bank. They'll go back and forth. They'll make sure that that check or that wire transfer is good. And then you withdraw money on the other side. One way to conceive of crypto is just simply a technology that disintermediates the need for those centralized financial institutions providing trust and allows us to send money and other pieces of property in a direct fashion, the same way we can send texts or WhatsApps to each other using our phones. That's a sort of 30,000 foot view, but I think people get confused when they think of it that way because it seems like an almost incidental advance. But there is a reason why you can send $1 billion on the Bitcoin network to anyone in the world 24/7, 365 and have it settle in a matter of minutes for a fee that is just a few dollars. There's a reason that this unmanaged software network can do things that the world's largest banks cannot do. And understanding that reason helps unlock why this whole crypto, Bitcoin, blockchain space is interesting. And so I want to give you a mental model for understanding what a blockchain is and why it's so important. And that mental model starts here. The core flaw in today's financial system is one of database architecture. The reason money is one of the slowest moving things in the world, the reason stocks take multiple days to settle, the reason any financial transaction is slower than getting goods delivered to your house on Amazon is not because the banks are trying to be slow. It's rather because of a financial database architecture problem. And that problem is expressed on this slide, which is that every financial institution maintains its own database. And so in order to send money from my bank here in the US to your bank in whatever country you are in, my money has to ping pong through a series of different databases. And each time it goes, say, from my local bank to a bank in New York, to a bank in London, to its final destination, each one of those transfer hops, the two banks have to communicate, agree that the transaction is sound, ensure that my account is not overdrawn, and then process that transaction. So because the world's financial architecture is a series of siloed databases, money moves extremely slow. It does not move at the speed of the internet or text messages. The way to conceive of what a blockchain is, and Bitcoin was the first blockchain, is it's a solution to a computer science problem which had existed for 30 years, which effectively asked, how can we have a new kind of database? How can we have a single database that's available everywhere in the world, that everyone in the world can see, that everyone in the world agrees is accurate, that updates in real time, but which doesn't have any single third party controlling it? It's easy to have a centralized database that different people can access. But how do we have a decentralized database with thousands or hundreds of thousands of copies available everywhere in the world that we trust to be true? And the Bitcoin white paper solved that problem. You can be in the farthest flung regions of the world and create a Bitcoin node, and you can see all of the data that's ever existed in the Bitcoin database. Now, this is not an incidental idea. This new database architecture that blockchains introduce allow us to do three things that we've never been able to do before. And if you understand these three things, you can understand where this industry is going and why so much smart capital is moving into the space. The first thing is the thing I've been talking about originally. Having a single database that's available everywhere, that everyone can see, that updates in real time, that everyone agrees is true, allows you to move financial goods over the internet at the speed of text messages. Because you don't need different databases to talk to each other and settle with each other, because the sort of record of transactions updates in real time effectively around the world, you can move, as I mentioned, $1 billion anywhere in the world in a matter of minutes for a fee that is less than a few dollars. Try moving $1 billion through a traditional financial institution, despite their scope, heft, etc. And it's not just money. It's literally any financial good, any valuable piece of property, which in the past took multiple days or multiple hours to settle, move, etc., can move and settle with finality because we have one database that everyone can participate in and see. This is a major breakthrough, but it's actually the least interesting thing that blockchains do. The second major technological primitive that blockchains introduce, the second thing that they allow us to do that we've never been able to do before, is we can now program money in the way that we would program any other traditional software. The reality of the financial world today is that much of what banks and financial institutions do is process simple if-then statements. What is a loan but an if-then statement packaged in a contract, right? If I go and try to borrow money from a bank, they look at my credit score, they look at my income, they look at my collateral assets, and they do an input and determine whether to give me a loan. If I have a trust agreement to pass money on to my son when he turns 30, it's simply a series of if-then statements. If Patrick turns 30, release $1 million to him from this particular account. Today, we wrap those in legal contracts and charge high fees to process them. But once money is native to the internet, once we can move money at the speed of a text message, we can use software to automate that, to program that. And as a result, we can make the financial ecosystem much more efficient. This isn't a far off dream. There's a huge part of the crypto market called decentralized finance, which we'll talk about today, that's already doing this at scale. Many of you may have heard of Uniswap. Uniswap is a decentralized software program that allows you to trade one crypto asset for another crypto asset. Last month, Uniswap processed over $50 billion of trading volume, despite having 0 employees, 0 offices, and being a decentralized platform. Imagine that. Imagine a stock exchange or another securities exchange that didn't exist 3 years ago and processed $50 billion in transaction volume in a month with no employees, no offices, no CEO, no physical entity. This is an early stage example of what you can do once you can program money like software. But the third thing that this new blockchain architecture lets you do is actually the biggest thing of all. So moving money at the speed of the internet is a big idea. Programming money like software is a big idea. But the third thing that blockchains create is digital property rights for the first time in history. If you think about a digital good like your bank account, it's just a string of numbers. The challenge with digital goods is that anyone can copy and paste that string of numbers very easily. You just push Control-C, Control-V on your keyboard, and you've created a copy. Historically, the way we've owned digital goods is we've had a third party maintain a database that says Matt Hogan owns this particular string of numbers. So our ownership was dependent on a third party maintaining a record of who owns what. We couldn't own a digital good the same way I own this iPhone because it's in my hand. But once we have one database that's available everywhere in the world that everyone agrees is true, that updates in real time, but that no single third party controls, we can have digital property rights in the same way we have property rights over physical goods. You can own an item in the digital world in the same way you might own a Picasso hanging on your wall. And this idea of digital property rights is seeing early expressions in things like NFTs. I'm sure we'll have a discussion about that. But the potential for digital property rights to remake the world is deeply significant. I know a lot of people look at crypto and they see the spectacular returns and they don't understand it. They look at something like Bitcoin, and this chart ended in January 20 of this year. It's up significantly since then. But they look at something like Bitcoin and they wonder, how is it the best performing asset class in the world over the last 3, 5, or 10 years? In this chart, it's up 770%. I've compared it here against other major assets like the S&P 500, gold, international stocks, emerging market stocks, and oil. And you can see crypto is the best performing asset class in the world. Or people look at charts like this, right? Bitcoin up tens of millions of percent over the last 11 or 12 years. And they wonder, how can this alternative currency that no one seems to use be the best performing asset class in the world over the last 2, 3, 4, 5, 7, and 10 years? And the answer is that it's not a currency. It's a new breakthrough in how we can use the internet. I'm 45 years old, and so I remember when the internet wasn't very useful, when the only thing we could do on the internet was send files to people. We called it FTPing. But over time, we've gotten breakthroughs that allow us to do new things on the internet. Like 1982, we figured out how to send text over the internet, and we created email. 1989, we figured out how to send links over the internet, and we created the World Wide Web. In 1994, we figured out how to put our credit card into the internet, and we created online commerce. 1995, we figured out how to send our voice over the internet, and we created VoIP telephony. And in 2009, we figured out how to send video over the internet. And now I'm talking to you from Berkeley, California, to people all around Latin America and the Caribbean. Each time we figured out how to do something new on the internet, we disrupted a major industry. Email disrupted the postal service. The World Wide Web disrupted media and advertising. E-commerce disrupted retail. VoIP disrupted telephony. The right way to conceive of crypto and blockchain, the reason we're all gathered here, the reason it attracted $33 billion in venture capital financing last year, the reason 55 of the 100 largest financial institutions in the world are actively investing in this space, and the reason it's been the best performing asset class in the world for the last 1, 3, and 5, 10 years is not because it's this new alternative currency that no one uses. It's because it's the technology that allows the internet to tackle money and finance. And money and finance is the largest addressable market the internet has ever gone after. With that, I think I've used up my 15 minutes, so I'll end my screen share here, and thank you so much.
Thank you very much. Thank you very much, Matthew. And now we go ahead with Jason. Please, Jason.
Hi, everybody. Good morning. Buenos dias. Thank you very much for having me today. Let me just share my screen very quickly. Bear with me. All right. So I get the good fortune of following Matthew, who's done an excellent job of laying the foundation for the technology and why it matters, and why it is going to be so powerful. I want to come at this from, I guess, from the other side, from the usability, from the adoption, as to why people are going to care about what this technology delivers and why we're going to see more and more people using it going forward. So I'm here to use my 10 minutes to convince you that the innovations that we're seeing in decentralized finance are going to be the driver for the next wave of adoption. And it's what's going to take crypto from sort of being a bleeding edge technology to something that we see underpinning the mainstream. To do that, I'm going to talk a little bit about the ecosystem as it sort of exists today, where we are in this adoption curve, why I think there's a need for this, why I think now's the time that we're going to see these developments, and some risks and opportunities associated with that. So it's a lot to do in 10 minutes, so I'll try to get through this. So first of all, what has happened in the ecosystem, right? Everybody knows about Bitcoin, Ethereum. It's been the opportunity of the last decade. Matthew showed the performance chart, but the ecosystem is now much more than just these asset classes. There's 5,000 plus coins, depending on how you want to measure them. But a lot of value and a lot of innovation has happened in protocols outside of the major two. This is a very quick heat map from a website called Coin360 that I like, that just sort of shows the breakdown of a lot of this. One of the big areas of growth that's sort of highlighted under the Ethereum box here is in alternative layer one protocols. These are alternative smart contract platforms that people have built on various use cases. And this has sort of been the first, I think, big iteration in technology as the ecosystem itself tries to solve for various use cases. People have a lot of criticisms around, Ethereum in the cost of doing transactions or the speed at which a blockchain moves. People are trying really quickly to iterate this technology to solve for real world use cases. And I think that this inherent innovation that we're seeing organically occurring in the space is one of the most powerful driving forces that we've got out there. The technology itself is great and is super interesting. I care more about what people do with the technology and how they iterate this into use cases and things that have meaningful impact on people's lives. I like to think about the crypto ecosystem as having gone through a series of phases that we try to kind of map out here. And it is this iterative process whereby people test things, see what works, and try to put resources behind those that get traction in an ever-growing sort of space. So, if we go all the way back to 2009, Bitcoin can be thought of as sort of the proof of concept for what we were doing in this space. We saw a huge expansion of the infrastructure during sort of the following 3, 4, 5 years. Developments of wallets, exchanges, custodial services, scaling payment solutions. People were really focused on sort of this base infrastructure piece. We then saw day-to-day use cases coming in. This might have been people using them for micropayments. It might have been people including them as part of cross-border remittance, where people actually saw inefficiencies in the market that this could start to solve on a very small scale, but actually working into these use cases. Expansion of these where people were building genuine solutions for them on the back of sort of the development of smart contract platforms into sort of more scaling use cases that we see today. The phase that I'm looking for next is mass market adoption or widespread adoption. And I don't think we are there yet, but I want to take a moment to sort of just explore the DeFi ecosystem, what it does look like today, and then we can talk about what needs to happen to take it to sort of the next level. So This is a chart from the block research that looks at the aggregate supply of stablecoins. This is something we've seen a huge explosion of in the last 12 or 18 months. And really what this is just representation of value in a blockchain native form that allows it to interact with the DeFi innovations that are out there. And I think that this is a really good yardstick for the amount of demand that we're seeing for the innovation in this space and the growth that we've seen it go through over the last kind of couple of years. And the reason that we've seen this sort of growth is that there's been this opportunity to put money to work in this ecosystem that was missing from the existing financial services. So here's an example of value that's being added by this innovation that people are showing up for. This chart here, it's from a website called DeFi Llama. All this information is very public. This shows the total value locked in DeFi protocols and the growth that it's gone through. Again, massive growth, now $231 billion against these protocols. For those that aren't familiar with the sort of terminology, total value locked is a measure of how much dollars is locked against a given contract. This might be lending, this might be yield generation, this might be liquidity provision, but generally it's an activity governed by a smart contract that is that's available to people in a blockchain native way, and something that they are extracting economic value from. So $231 billion growing from essentially nothing in 2020 shows the massive growth and the start of the adoption of these protocols. Very quickly, these are sort of the top 10 that we see out there. Uniswap, Matthew mentioned this one already. We can see on here sort of the value locked against these protocols, the changes that we've got from them. Interestingly, we see these protocols as well deployed against multiple blockchains. So the point I sort of try to make here is that this is becoming quite a diverse ecosystem. And a very interconnected one, that these innovations that have grown up organically as part of this movement are available in multiple iterations of this technology to deliver it to different people based on their use cases, their needs, and the way they want to interact with that ecosystem. So very fast growing, increasingly nuanced, and very iterative and innovative. The final one I show for just the current state of the market is the growth in, this shows the growth in commodity-backed gold tokens. So this is now an example of taking a real-world asset and making it available in a blockchain native way so that it can interact with these innovations. Growing very quickly, still very nascent, but there is now this whole movement of more real world or more traditional assets being tokenized, put to work in this DeFi ecosystem because people are extracting utility out of it. So this is, again, another very interesting use case of how people are extracting value from this technology. All of that said, and that's really impressive growth for the space, it's still very early. We aren't seeing this go to the mainstream yet. This is a chart of an adoption curve, right? And we are still at the very early stages of this. Maybe we're creeping into the early adopters part of this curve, but we're still at the early days of it. When people talk about technology adoption, they often talk about the chasm that's represented here, about how we go from early adopters to an early majority or mass market of a given product. And this is where products really need to, or a technology rather, really needs to find its feet for its use case, for the value that it adds to people in a much more usable way than I think what we see today. Interacting with a DeFi protocol is difficult. If you need to go and set up a MetaMask wallet, manage private keys, understand the risks and practicalities of doing all of this, you have to be very committed to that feature set, those values at this state in time. My mother is never going to go and run a MetaMask wallet or manage a private key on her own. So the next wave of what we see coming next is really looking for a much more complete offering that enables people to access this natively. And I think that this is what we're going to see next in DeFi. This is the iteration that we're going to see. And I think this for two reasons. One, I strongly believe that there is a need for this, that people are not getting what they deserve from financial services today, and that DeFi is going to be the answer for solving that. And I also think that now is the right time for it because we have the right confluence of technologies available that are going to be unlocked by blockchain to deliver this to the mass market on a scale that we've seen for the internet. So why is there a need for this in financial services? Matthew touched on this like really interestingly from a technology perspective around why there is like structural inefficiency and why this new wave is better. I want to talk about it from the user experience of those that interact with the system. And I point to three things in this space. So one, poor response to digitization. Financial services in general has done a really bad job of digitizing, particularly when you compare it to other industries. The amount of change that we've seen in retail as a result of Amazon, the whole business model is fundamentally different. We haven't seen the same thing in financial services. You know, the move to online banking is really just a replication of forms that we used to do in person, pen and paper. They replicated that online and asked people to continue doing that. It has not moved on with the times. We haven't seen the business model moving on. Now, that's not entirely the fault of the institutions themselves, although they are very big and bureaucratic and slow moving when it comes to technology. But the underlying system really does stand in their way of being able to do these things in a native fashion for all the reasons that Matthew went into in the previous presentation. The space is fragmented, which brings us on to the sort of second point. It's a fragmented space that all the solutions lead us to becoming more fragmented. So I say to the industry's had a poor response to digitization. That's not to say everyone's doing a bad job and people aren't out there trying to solve problems. There's been a lot of fintechs that have come along, offered solutions up for problems in this space. So a great example of this is Venmo in the US, which many people may have used. It's essentially, it's an incredibly popular app. It's a billion-plus company that's designed to simply solve for a structural inefficiency of sending money from one bank account to another. Now, it made that experience better, but it added to the fragmentation, meaning that you now needed another app to do something very basic for me to send money to a friend to, you know, cover dinner last night or whatever the use case might be. So we have a market here that's becoming increasingly fragmented, which, whilst you may solve one problem, will open up a gap in something else. And this leads to the third one, which is this fragmentation and you know, both through the companies and geographic fragmentation, which I'm sure everyone's aware of, opens opportunities for rent seeking in the space. And I think that this is sort of a fundamental problem in the existing system that won't get solved without a total reboot. Best example for me is sort of cross-border remittance and what we see in that space. It got highlighted by what recently happened in El Salvador as they adopted Bitcoin as legal tender. And it's sort of a lot of the news around this was on the nature of that country, its economy, and the way the cross-border remittance works. So 30% of the El Salvadorian GDP comes from cross-border remittance, people working overseas, sending money home. And off that activity, Western Union makes $400 million a year from a country where the average person makes a couple of thousand a year. That sort of inefficiency in the system is a real drag on people, on the global economy. And so there is a need for something better here. And this can be, I think, achieved through what we're going to see in the next innovation of things. We're going to be able to move this forward now because we have the right confluence of technologies finally to do this. And this is maybe a little bit obvious, but you know, the internet and smartphones are technologies that have been around for a while, but haven't been as I've already made the point, that financial services didn't respond to these particularly well. But there has been sort of a lot of work done and a lot of best practice that is out there for how to do mobile first businesses, in how to do internet first commerce. And the big thing with this that is going to be an underpinning for the real growth that we can see is that we now have a very interconnected world as a result of these two technologies, where we have better part of 7 billion people on the planet that are all connected to each other by a supercomputer they've got in their pocket. If we can build a financial services offering on top of that, that's going to be very powerful, the scale and efficiency that can achieve. I have exchange traded funds and robo advisors on here because I think these are two really good financial services innovations that have happened over the last 20 years that lead to a sort of technology and skill set that can be leveraged into the new world. This idea of wrapping exposures, of standardization, of single points of access that we got from the ETF innovation and the expertise that has been built around that shows us how a market that is based on these principles delivers better outcomes for those that use it. Taking the skills of sort of wrapping in exposure, of standardizing it, this looks a lot like tokenization, and I think can be leveraged very heavily to build the next set of financial services. Robo-advisors is a data-first approach to customizing a financial services experience. I think, again, this will be taken to the next level by something that's truly internet native and dealt with for 7 billion connected people, and will drive the next wave of growth. Blockchains and smart contracts, we've talked about a reasonable amount, but these are the technologies required to unlock financial services to become truly internet native, to take advantage of these other technologies and drive forward this wave of innovation. All of this together, I think, is happening now, and why I think what we see develop next is going to truly drive mass adoption of this technology. Bringing this back, there's a lot of ways in which, you know, people can take exposure to this. I think, you know, we've had a lot of innovation in space. People are generating returns from DeFi, from yield generation, from investing in the tokens directly, from taking exposure to equities that are building in the space, or buying the underlying blockchain protocols. I think all of these are really valid ways in which people are extracting value. A lot of what I've talked about today is about the next wave of growth. And quite often when I'm talking to clients about this, they're looking for what the next innovation, the next big thing in the space is. For DeFi, a lot of people are very focused on the DeFi tokens themselves, and that's a completely valid way to look at the space. I would highlight the fourth one on here is the underlying blockchain protocols, whereby the amount of value that will be retained in these networks as a result of mass adoption is going to be very powerful. And I think the way to sort of think about this is, if you could have invested in the internet during the 90s, it works very differently, but for the first time, we've got an opportunity to invest more natively into this protocol itself. Now, and that is going to be very powerful. So we've seen a big wave of growth. I think there's another one coming as this starts to go mass adoption. I think DeFi is going to be the driver of doing it. There are things, of course, to be mindful of in this space. There's a lot of regulatory uncertainty. Picking a winners and losers is very, very hard. You know, in 96, Amazon and pets.com looked very similar. And we're not in a dissimilar place right now, whereby working out which protocol, which DeFi faction is going to win is going to be hard. There are, of course, security concerns around it, and there are issues of this ecosystem building trust with the mainstream. But all of this, I believe, is uncertainty around when, not if. This is an innovation that is coming, that is going to be powerful, that is going to help bring billions of people into a more equitable financial services system, one that is cheaper and more efficient. And so that's going to be a matter of time, not a matter of if. This is sort of my final thought, and I think it's you know, a good way to kind of think about this, but DeFi could very well be the internet moment for finance, similar to what we saw in these other industries. What Amazon did to retail, what Netflix has done to television, what Facebook has done for advertising. These industries look completely different as a result of the use cases for the internet technology that was delivered by these three companies. We're going to have this moment for financial services as a result of what is being built in decentralized finance right now. With that, I will pass on to the next speaker.
Thank you very much, Jason, for your presentation. Just comment to the audience that they could put their questions to the Q&A icon. After Matthew Siegel's presentation, we will have the Q&A from the table. Go ahead, Matthew, with your presentation.
Okay, Melvin, CFA Society, Inigo, everyone, thanks, and thanks for the nice lead in. It's kind of ironic to be presenting in front of CFA Society. My Twitter handle says recovering CFA, because although I trained and learned the practices of security analysis in 2016-17, I became convinced that the underlying technology behind Bitcoin and cryptocurrencies was going to disintermediate traditional finance and allow individuals to pool capital in an innovative way that would make traditional valuation somewhat irrelevant, and that's kind of played out. I'm just going to give a little bit of background on Van Eck. We're a family-owned money manager, about $80 billion in assets. The firm has its DNA in the gold market, runs the largest gold ETF. So became convinced in 2017 that that Bitcoin and cryptos could be a disruptive threat to our core business. We run an indexing company that has 40 plus digital asset indices that form kind of the backbone of our intellectual property. And then we've begun launching crypto funds, including 8 ETPs in Europe, both single coin and multi-coin funds, and then 2 private LPs in the US, which we can talk about. I mean, the general macro view here, right, is that government has taken an increasing role in setting prices ever since the financial crisis. Folks in emerging markets know that firsthand. Developed markets investors are kind of becoming reacquainted with this phenomenon. And as Matt Hogan mentioned, right, everyone on the Bitcoin network can agree on the truth every 10 minutes. And that type of certainty and agreement is in short supply globally, in the media, and among our policymakers. And there is some evidence over the last few years. We'll see how it plays out. That Bitcoin can be somewhat of inflation protection. And in a world of essentially zero interest rates, 60-40 portfolios have become outdated, and there's good evidence that adding this diversified asset class to a typical 60-40 mix can improve returns and improve volatility. So here's what's happening with Bitcoin generally. So the left-hand side is the quarter-over-quarter growth in addresses, just how many different Bitcoin addresses exist in the world. It's a very broad number, but it generally has been growing in the 1% to 2% range month over month. That decelerated in the second half of last year, but notably, despite the 50% peak to trough decline in Bitcoin price, the growth rate in new users has not decelerated even year to date, and the amount of energy being used to power the Bitcoin network is reaching an all-time high. So from the supply perspective, more and more miners are realizing the value of this network, global computer network that anyone with an internet connection can join to send value across the internet. And our thesis here is that what started out as an extremely volatile asset is eventually becoming less volatile, and that rests on these new institutional entrants, which are coming into the space in great numbers. So the left-hand chart is the number of SEC filings mentioning Bitcoin. So this is Q1, all right, all-time high. So Bitcoin goes through cycles. Every 4 years, it becomes twice as difficult to mine a new coin, and it is post those halving events that we tend to see the most explosive gains, and before them when we tend to have a sell-off. So we've had 2 80-plus drawdowns in Bitcoin since its inception. Our thesis is that because of these new chunky institutional buyers, that the downside will be limited to 50% this year. And so far that's been playing out. The thesis also is that volatility will continue to fall. And for those who think that it's been a volatile month or a year to date for the markets, so the orange line here is Bitcoin's relative performance versus the NASDAQ. continues to make relative highs. The white line is the volatility. So Bitcoin volatility divided by NASDAQ volatility. We continue to make lower highs and lower lows. Interestingly, there have been more 1 standard deviation moves for the NASDAQ this year versus its 5-year history than for Bitcoin versus its 5-year history. Bitcoin volatility continues to fall. One thing that we find missing in this ecosystem is a standardized sector approach. And so, we went ahead and built one. After all, we have our roots in indexing and then manufacturing funds that either match an index or for actively managed funds that aim to outperform an index. So we spent much of the year working on this taxonomy of digital assets, creating a form of like GICS sectors that investors can use to measure token performance in a way that's mutually exclusive. So we found that a lot of competitors and third-party research that we were consuming tended to create investable baskets, some of which overlapped. So we wanted to, recognizing that this ecosystem changes very quickly, we put one coin into one category and then rebalance monthly, and those indices you can now track on Bloomberg and FactSet. You can compare them against traditional assets. We think this type of visibility is going to give institutional investors more comfort that they can understand the drivers of performance. So let me just spend a few minutes on some of these sectors. So store value, right? That's an obvious one. That's Bitcoin. It's a unique network. It's a proof of work network in which you actually have to run the CPU yourself to generate, those millions of guesses to solve the cryptographic puzzle that will eventually reward you with Bitcoin. And that energy intensity of that network is a feature, not a bug, and it makes it more secure than all the others. And so Bitcoin kind of stands alone. But the 4 sectors in red here are those that we see as most investable, either because they're well diversified or because they don't include securities or tokens that are likely to be securities like these exchange tokens. So we really focused on these 4 sectors in doing our early indexing work, specifically the smart contract platforms. Think of these as the open source operating systems on top of which developers can build a range of decentralized applications that will eventually compete with the Spotifys and the Googles and the PayPals. But you need these financial primitives, somewhere between a dozen, 2 dozen layer 1 operating systems, kind of like the TCP/IP or MS-DOS in the early days of the internet that developers congregated around and build apps. And so here you can see kind of how that decentralized economy stacks up at the base layer, these smart contract platforms led by Ethereum, who essentially capture a tiny commission on every transaction that goes across the blockchain. And each of those layer 1 chains is architected slightly differently to achieve either speed as its primary function, or cost as its primary function, or security. There's trade-offs that the engineers have to make when designing these layer 1 chains. And so because of that, we think there's room for many of them. And if you look over the last year, been a bear market here since November with 50 to 70% declines in many of these coin prices as the world digests the impact of higher interest rates on the valuations of growth assets. And Ethereum and smart contract leaders, although they're generating cash, they are growth assets and somewhat highly valued. But nevertheless, it's been Ethereum and the smart contract platforms that have outperformed. And I'll just spend a few minutes on kind of how we think about the valuation and portfolio construction when we're buying these tokens. So on the left-hand side is Bitcoin's total value transferred across the network. It was about $4 trillion last year. Huge acceleration as institutions and sovereign nations began using this network to conduct large transactions. So ETH and Bitcoin are now each about 4 times the size of PayPal, growing 10 times faster. And PayPal, the way that many investors value it is that they look at the market cap, divided by that gross amount of value that's transacted. That's how they look at Shopify, Amazon before Amazon was profitable, that like price to GMV type of valuation technique. And you can do that with Bitcoin as well. So that's what the left-hand chart shows. It's the market cap divided by that denominator, which was the total value transferred across the network. And on that basis, Bitcoin's pretty cheap versus its history. And then you can do that across asset classes as well. And although Bitcoin, is the most expensive, it has that security premium. It has the fixed supply, right? The only asset in the world that doesn't respond to higher prices by making more. And as a result, the monetary premium, makes sense. There's a fourth way that we can value some of these newer proof of stake currencies. I'll use Ethereum just as an example, although it's still on proof of work. Ethereum, 3.6 trillion in value transferred last year. On that, the miners who contribute their compute to the network and earn fees and block rewards in return, they captured $17 billion in revenues. So if you divide 17 billion by 3.6 trillion, you're at something like 30 to 50 basis points. So that's the take rate of Ethereum. Contrast that to the take rate of Web2 platforms like eBay, PayPal, Shutterstock. If you sell 100 photos on Shutterstock, you're paying 80% of your top line away. And you can see the value case for Ethereum as a platform as it transitions to this proof of stake model, where investors, instead of running the CPU themselves, will buy ETH and then stake it, meaning that they lock the liquidity, commit not to sell it. Others will use those resources to spin CPUs and GPUs, and whoever has staked will earn an interest rate denominated in that native coin. You can track those interest rates. You can track the number of coins that were staked. If you multiply one by the other, you end up with a revenue number, what a rational buyer would expect to earn from one of these protocols by buying and holding, assuming that the token price was flat. And that number adds up to 13 billion. So you add the 13 billion of these smart contract platforms to the 17 billion for Ethereum, it's $30 billion. And you can start to value the index that we created. The smart contract leaders index has about $500 billion in market cap. So it's about 20 times sales, right? That's more or less what you're getting for smart contract leaders. So I'm going to stop there because I think I've taken up my 15 minutes, and we'll move on to questions.
Thank you very much, Matthew Siegel, for your presentation. Actually, this is a lot of topics, and it's very difficult to grasp each interesting questions. Okay, so for the audience, please, you could introduce your question through the Q&A icon on the platform. I will start first with Matthew Hogan. Matthew, massification probably will be the next big leap in this sector, I don't know, in the next 5 to 15 years, because this is a long-term process. So what do you think will be the next big change? I mean, for example, Salvador did something which was very aggressive, the adoption of Bitcoin as a currency, legal tender currency. So is another regulator, maybe European Union regulator, that has been starting to regulate the cryptocurrency market, but information was floated to markets, and they was like planning to basically ban the proof of the Bitcoin mining process because it could contaminate. So where is the next big move that everybody needs to see, that the massification is basically coming fast?
Yeah, great question, Melvin. Also great presentations. Jason and Matthew, really enjoyed them, learned a lot. I think you pointed to the next big development that I think is going to unlock the next big bull market of crypto, which is progress on the regulatory front. The history of crypto as an industry has been sort of reluctant and worried about regulation, worried that regulation would constrain its growth, worried that regulation would halt its progress, worried that regulation would do things like make parts of decentralized finance impossible to operate. And all of those worries are valid. Regulators can overreach when there's a new technology and they have limited understanding. But one thing that's changed over the last year and a half in crypto in the US and globally has been a shift from a regulatory perspective, from focusing on risk to focusing on opportunity. You mentioned the example of El Salvador embracing Bitcoin in a strong way as a sort of shot on goal for new economic and differentiated economic growth. I think that is an early example. But even in countries that have historically been uncertain about crypto, worried about crypto, and when there are risks of significant crampdowns on crypto, we've seen a real change in markets. So here in the US over the last year, Congress has gone from crypto skeptical to crypto engaged. And I think the next major wave that will unlock a massive potential bull market in crypto is when we see regulations and laws enacted that put regulatory frameworks around crypto. It almost doesn't matter to me what those laws are. The most important thing is that those laws are crystallized and we remove the haze of regulatory uncertainty. And I suspect we'll see that in most major countries and most major economies over the next 2 years. I'm really strongly optimistic about the regulatory upside.
Melvin, I'm gonna jump in because I think that you asked what's going to drive this into the mainstream. I mean, it's happening right now with what's going on in Russia, right? Like Europe and the world is kind of waking up to the importance of energy independence. And frankly, here's just 2 slides I didn't get a chance to show, but like Bitcoin incentivizes energy independence, right? So for El Salvador, a poor country, 4,000 per capita GDP, they don't have the resources to build solar and wind and buy all the batteries, which everyone agrees are in short supply for the world to move to renewable energy. What they do have is this volcanic energy that's locked inside their country. And because Bitcoin mining is so flexible and the capex required is not so great, they can co-locate these Bitcoin mines right next to the volcano. They can monetize that energy and sell it 365, 24/7 and buy whatever they want. In their case, they're buying hospitals, right? In the case of Texas, they have a lot of excess energy in the form of this methane and gas that's flared from shale wells. And that's why the governor of Texas has now signed a law creating a master plan for expanding blockchain industry in Texas. By some estimates, the flared gas from these wells alone could power 25% of the Bitcoin network. And as we move to renewables, we're faced with this increasing phenomenon of negative energy prices. Essentially, we've created all this wind and solar capacity in Texas. It's a remarkable freak of nature of topography that they have all this energy. There's not enough demand. The demand is over here in the coasts. We're not building high voltage transmission lines. What they can do is when they have this excess energy, they can monetize it with Bitcoin co-located next to the negative energy. And that's an efficient way of increasing renewable energy. So, I think Russia is a catalyst for that. But I think as we've seen from the Bitcoin mining migration to Texas over the last year, a lot of people are getting this now.
Thank you, Matthew. Both Matthews. Jason, any thoughts on this?
Look, I agree with what both the guys have said. Regulation is really important. I think the importance of this regulation is going to be a big driver. I think it's coming more to the forefront of everybody's mindset, and clarity is going to be a huge part of that. Matthew's right that these use cases are being made apparent by events that we see around the world. What happened in Canada is actually another really good example where they took away the ability for people to take civil action against banks for freezing accounts. This is another example of why having higher degrees of ownership or transparency on the value that you hold is important. Digital property rights, which is what Matthew talked about. And then I also think, just to reiterate a point that I was attempting to make, is that the organic innovation that we're seeing around this space is truly staggering. That the smart things that people are coming up with, like DEXs, like AI, like automated market making algorithms, solutions to financial logistics problems that aren't coming out of banks, but are coming out of open source coders anonymously putting this software out on the internet. I am honestly just baffled by the amount of innovation that the space is organically creating. And that is, I think, going to be such a powerful driver of real world use cases of making people's lives better. as a result of this technology. And if that doesn't take something mainstream, I'm not sure what will.
Okay, I want to ask you, all of you, regarding one of the questions of the public, but this is in the mind of everybody in the financial markets, watching the evolution of the asset class. No, a new asset class that has, depending, of course, on the market momentum and the pricing of the currencies, $3 trillion, $2.5 trillion, $2 trillion. Anyway, it's more than 1 trillion, and that is very meaningful for global investors, institutional, retail ones. So everybody is asking the reaction of the central banks globally. And there has been different approaches. No? Most of them have announced it in Europe, in Asia, also in Latin America. Central bank governors are studying the possibility to issue digital currency. So we will start with you, Matthew Siegel, on this. How do you think will be the next response from the central banks? Maybe it's different in Europe or North America, but something will happen, because if you understand the monetary theory, demand drives the supply. So if the demand in the world, I mean 1 billion or 2 billion people adopt Bitcoin or Ethereum or other currency as a reserve of value or as a transactional instrument, there will be changes. So monetary institution will not be away from this evolution.
Agree. I mean, central banks are not the only government entities, right? So we saw, Russia's was an extreme example, but the central bank came out opposed to Bitcoin, and Putin said, you know, I don't care. Russia has advantages. I overrule you. So there will be cases when elected officials overrule central banks or guide central banks, and we'll see. You know, some of the central bank digital currencies we've seen so far, like the one out of Nigeria, has nothing to do with crypto. It's just a surveillance tool that imposes negative 20% real interest rates on citizens, doesn't let them, you know, perform remittances, and has no real value, and we'd expect it to see limited usage except under coercion. So if you're coercing citizens to use your central bank digital currency, you know, you're probably not going to gain market share of capital flows. So that would be our view. Public sector will try to compete in digital money. We've seen you know, how governments compete with technology solutions. They tend to be inferior. The private sector tends to have a better mousetrap. So, you know, those societies that coerce citizens into using CBDCs, as China has hinted, as Nigeria is doing, they'll lose market share, and the countries that do the opposite will, and strike the right balance of private and public sector competition, will gain market share.
Mm-hmm. Jason.
Look, I think that's pretty much right. Like, this concept of competition is huge, and this idea that you will have choice in an ecosystem that drives innovation is very powerful. Central banks deploying a CBDC, it's not a one size fits all. There is a lot of nuance in how that can get implemented. If I create a blockchain native central bank currency, but the only people that are active in that network are banks, then all I've done is essentially digitize the M1 money supply, and the system doesn't look any different. So how does the value actually get added to the end users, the people that still have to have bank accounts with an intermediated system that has all the rent seeking and fragmentation problems that we see in the existing one today? So it's just to make the point that there's a lot of nuance in that. If they want to put something out there that is truly open and accessible and, you know, usable and encourages sort of private sector innovation in terms of how we could connect to that money, where it could be transferred, how quick it would move, then that might be a really powerful, compelling proposition for people to build business models around. Because at the end of the day, that's what we need to see happen. We need mass market business models adding value to people every day. I'm not sure that that's what we're seeing at the moment from CBDC. So I can see one of the questions in here is, why would the existing crypto ecosystem have value if a CBDC is out there? It's because it will be heavily controlled, because the CBDC is unlikely to have the same connectivity or innovations. We see things like metaverse and NFT and a more interconnected world as a possible future. It's very hard to see any of the CBDC projects at the moment being a meaningful driver of those real world use cases, at least in the implementations I'm seeing today.
Mm-hmm. Matthew, Hogan, regarding this concept, and this is, I think, a critical difference between a central bank legal tender currency and the blockchain. No, it's the centralization of service providers that supports the currency. So probably, what is your vision? It's possible to have a crypto euro, for example, or a crypto dollar that could compete with Bitcoin or Ethereum, or basically it's not possible because legally, always these are centralized currencies.
Yeah. Oh, great question. Look, I think every central bank is going to develop a central bank digital currency. If you flip the question on its head, will central banks not move to digital currencies in the next 20 years? It seems obvious that of course they will. Every central bank will. They want that surveillance capability that Matthew spoke of. There's also a manifest destiny of sort of the technology and efficiency that it bears. So they're going to exist side by side. You really can't have you can have private versions, you can have stablecoin versions of crypto dollars or crypto euros. But in the end, the ability to issue fiat currencies is something that governments hold. So my view of the world, you're going to have central bank digital currencies that people are going to use to match assets and liabilities, particularly over short periods of time. And you're going to have this rising chain of decentralized alternatives represented by crypto that will live side by side, and they'll have different use cases, right? Today, the world has a global financial rail that's centralized around the dollar. I suspect that those days will end eventually, and we'll have different apolitical financial rails that facilitate international transactions along with the dollar. It's just a world of more competition, and each particular currency, centralized or not, each particular financial rails, nationalized or global, will find its individual use case. It's a more interesting world than the world we live in. But I really think it's inevitable. I find it shocking that people ask, will central banks develop currencies? It's like asking in 1992, will newspapers have websites? Of course they will. They have to. It's inevitable. And I think they'll just compete side by side and be good at different use cases.
Okay, moving to the mainstream adoption. Institutional investors, of course, are the largest players everywhere. So, Jason, what is your ideas about the adoption for institutional investors? Who will be the first one, or who is right now investing here? No, what will happen with pension funds, with sovereign funds, and because both of them are the largest institutional investors in the world. No? How do you see this evolution of adoption of crypto assets for institutions?
It's going to continue. So it's already happening, and it is already happening, I think, across the spectrum. Our primary business is talking to institutional clients. Crypto as an asset class is by far the most popular topic. And we have interest from sort of every segment, like let's say from the very fast moving family offices, hedge funds, all the way up to sovereign wealth and pension clients. It definitely skews. There are more family offices doing it, but it's by no means a homogenous approach at this stage. That's not to say every family office is in and every pension fund is out, but everybody is coming to this at their own pace. I think it's early days. People are looking at it. The slower moving end is the bigger end, pensions and sovereign wealth. But those that are forward looking, that have management teams, that have CIOs, that are sort of seeing what I believe is the writing on the wall, are moving into the space. And we're only going to see that accelerate over the coming years. I think the adoption of this is inevitable. It's a matter of when, not if. And those that move first will have an advantage over the others in their space. We've seen sort of a numerous number of sort of institutional surveys or advisor surveys looking at what clients are after. And what we consistently see is a growing number of users saying that they will switch providers based on availability of crypto, of inclusion of crypto in the investment portfolios, or the ability for their advisor to provide them with access. So this is a trend that I think is very, very clear. And there is going to be somewhat of a survivorship bias on this, because those that don't move into crypto will fall away, will fall from relevance. So we'll see a big push on this, and it's only going to increase over time.
Mm-hmm. Matthew Hogan, Bitwise was one of the first companies creating ETFs in the market, no? And you are recognized for that. Which do you believe is the main challenge for mainstream institutional investors? I mean, they have a very specific process of investing, no? Like custody, liquidation, and other processes that the financial systems has begun to provide for institutional markets, including, of course, derivatives and future markets and options and everything. So which is your expectations about the big moves in institutional markets? Because once the pension funds decides, for example, to allocate in the asset class, crypto assets is a crypto asset class, this is a digital commodity asset class, they need to because they do asset allocation. This is a very disciplined process. So which is the asset class for institutionals?
Yeah. Well, it's funny, you know, you're kind of asking, Melvin, what is keeping institutional investors out of crypto to this point? I agree with Jason that it's inevitable that they're going to move in. I think the real answer to what's keeping them out right now is fear of being fired. Crypto is new and risky and volatile, and you need someone when it's a non-consensus bet, when you're making a non-consensus bet, you need an act of bravery to push a slow-moving institution over the line, because if you make a non-consensus bet and you're wrong, you're out of a job. If you make a consensus bet and you're wrong, you still have your job because everyone was thinking that. When you make non-consensus bets, you better be right. Otherwise, it's very risky. And I think that behavioral risk is the single biggest risk. It used to be, if we back up a few years ago, that there were other meaningful risks. Custody was not available at an institutional level. Trading and liquidity was not available at an institutional level. Investable products like the kind that Van Eck and WisdomTree and Bitwise were providing weren't well established, but all of those have changed. There are now high quality institutional custodians. Major market making firms like Jane Street are making markets. Investable products are available in multiple markets around the world. So I think it's that process of education and normalization that is the biggest gating factor. I would add, for institutional investors out there, if you're not allocated to crypto today, you're net short the market, right? Crypto is a $2 trillion asset class. Global equities are a $100 trillion asset class. You should have 2% of the value of your equity portfolio in crypto. That would be the market neutral position to have. And the average allocation among institutional clients is still zero. So they have a long way to come up the curve just to get to market neutral. And there are many of us on this call that think it's the most attractive asset class in the world and that you probably want to be overweighted, but they are net short or net deficit at the moment.
Just to pile on to that point, but I couldn't agree more, right? It's almost like if you aren't allocated now, you're systematically betting against it. You think it's going to zero in the next 10 years. And I'd find that quite a ridiculous position to try to justify. And it just seems like the most asymmetric risk profile you could have on an asset class. 2% allocation might go to zero over 10 years time. Okay, that's cost you what, 20 bips a year on your portfolio, but has the potential to add multiple zeros to the size of that holding. That's an insane bet not to that's an insane position just not to have in your portfolio. I make comparisons to like internet stocks in the night. If you go back to 1990, the IT sector was basically non-existent. It accounted for 0% of the global equities market. We can argue about what exactly falls into that, but it essentially grew as a result of the internet. It now accounts for 30%. Like that's that technology as a result of the internet being adopted and integrated into business models. Account went from 0 to 30% of global equities in a 15-year period. That's what we're talking about potential wise here. So betting against it is, I think, a very difficult position to justify.
Michael Siegel, what do you think on this? You presented the asset class of your classification on different sub-asset class. So for Van Eck, is this a digital commodity asset class that institutional investors could allocate, like Jason and Matthew Hogan said, 2%, 3%, like hedge fund asset class? Hedge funds is an asset class. And most of the largest institutional investors have allocation of 1%, 3%, 5%. Do you think this could be the case? And the other question related to the public also question is which of the sub-asset class could be the most successful following the next 5 years horizon, for example? Is metaverse, is DeFi, is smart contracts?
Yeah, so on the allocation question, we're speaking to a lot of family offices, high net worth institutions, and there are some who are getting quite a bit more aggressive than 3%, and they're doing that by segmenting this asset class into kind of three different accessible avenues, right? One is Bitcoin as a store of value, a competitor / cooperator with gold, and store value as a percentage of your portfolio. Maybe it's 0 to 5%, and maybe it's split between Bitcoin and gold. Maybe it's all one, maybe it's all the other. Let's see, right? So that's Bitcoin, unique. The second avenue are these tokens, which are a disruptive technology that are taking market share from Web 2. And the way to access the value that they're creating is by buying these tokens, the ex-Bitcoin tokens, and thinking about them as akin to the growth equity part of your portfolio. And when you think about how big FANG is in a diversified equity portfolio, FANG is 20% of the S&P 500. Maybe you'd put 2% into these ex-Bitcoin tokens, 2 to 3%, and think like, oh, that's 10% of my FANG allocation. Right now, it's correlated positively, but over time, if FANG breaks down, it's going to be because this technology has disintermediated them, taken down their margins. So that's bucket number 3, 0 to 5% in tokens as growth equity. And then there's the lending opportunity. So there's an entire fixed income universe being built in crypto. You can now earn interest on your Bitcoin. And there are many investors who are accessing the lending and borrowing aspects of crypto, putting it in their fixed income portfolios. We have a fund that's earning 8% with quite low volatility, and folks are slotting that into maybe the private credit part of their fixed income portfolio. If that 60-40 allocation is broken, what percent of the 40 can you put in a strategy like this? So 5, 5, and 5, that adds up to 15%. That's a very aggressive allocation, but we have seen clients exploring that. And then for your second question, I guess one thing that we observe is that many of the early institutional investors made good money in venture capital. Some of those funds are coming due. They're asking for long lockups. They're expensive vehicles. And so as the asset class matures, there's going to be demand for more beta type products, ETFs like Matt Hogan is building, and even LPs that can track some of these sectors, hopefully adding a little alpha along the way. In the US, we're constrained by how we can offer those products, so they're in LP form. But it's those 4 sectors that I mentioned: smart contract platforms, DeFi, metaverse. Those be like the 3 that we are particularly focused on right now.
Okay, thank you, Matt. Matthew Hogan, there is a question from the public. What are your thoughts about El Salvador Planet 1 billion Bitcoin bond? What is the greatest risk? This is very unique also.
Yeah, it's a great question. I think the Bitcoin bond that El Salvador is pushing out there is an interesting strategy. Again, I think it's a sort of an asymmetric bet to focus attention and spark economic growth. The biggest risk in that particular bond is that the planned payoff assumes a rapid appreciation of Bitcoin itself. And that's somewhat circular logic to build into a traditional fixed income instrument. So I suspect it's likely that they will succeed with that bond. I even suspect the payoff will work out because I'm optimistic on Bitcoin, but there is a circular reflexivity in the design of that fixed income instrument that people should be aware of before they buy it.
Mm-hmm. Another question from the public for Jason. What are your thoughts on venture DAOs? Will they be the next venture capital funds in Web3?
It's a really interesting question, and I'd kind of decompose it into 2 bits. So there's DAOs as a sort of wrapper for pooled investment, and then there is sort of what they're investing in, which tends to be pre-IDO tokens, both of which are super interesting. So I think as a way of taking exposure to innovation in a Web3 environment, in an open source protocol environment, buying into the governance tokens in an early stage is a super interesting investment proposition and looks very similar to venture or private equity investing, and I think is going to yield some very, very strong returns for those that are able to, effectively navigate that space and find the winners in there. Again, very, very similar to what we see in traditional venture. Wrapping that in a DAO is an interesting idea. Again, I think that DAOs are an incredibly powerful idea. This idea of a decentralized organization, something that is, let's say, a little bit meritocratic in its kind of design. But I think there are still a few questions around accountability, around governance that come with DAOs that haven't yet been bottomed out. Are we going to see institutional investors sort of investing into these in a serious way soon? I don't think so, because of some of those governance concerns. But it is one of these organic innovations that we're seeing coming through the space that I think will go through several iterations and result in finding its place in the world, finding its use case and its value, and growing up to be a more substantial part of kind of the investing ecosystem. But I don't think it's quite mature enough yet.
Thank you, Jason. And final question from the public for Matty Siegel. If Ethereum reaches L2, do you think it will capture most of the market?
Okay, so I guess the question is, once Ethereum merges and becomes this proof of stake network with a bunch of shards, will they begin to retake market share? And I think a market share, if you think of like that total value locked in DeFi that Jason showed, depending how you measure it, 200 odd billion. Ethereum 12 months ago was 90+% of that market. And then as these additional like layer one chains have become more mature and applications have been built and released and tested on top of those chains, Ethereum's market share has come down, and it's now kind of in the 65% range. Will Web3 show the same winner-take-all characteristics that Web2 did, where single companies have 80+% market share with 80+% margins? We think that's unlikely because of the participatory nature of this technology, where anyone can join the Discord, talk to the founders and really shape the monetary policy of the protocol, the future vision. It's just a more connected ecosystem, and so it won't be winner take all. And while Ethereum's merge should be quite positive in terms of increasing the capacity on the network, it's unlikely to result in retaking of a large percentage of that market share. Instead, it'll just be a rising tide lifting all boats. That's our view.
Okay, thank you all of you. Just to finish with a last comment, we did a survey between our members in the region, Caribbean and Latam, and crypto asset was the main topic of interest, which is very unusual when you realize who are the CFA members, because these people have taken 2 or 3 years and studied to pass the exams, and most of them are working in the traditional financial institutions, from central banks to banks, asset managers. So it's very interesting, the level of interest that the crypto asset is actually.
You're on mute, Melvin.
Yeah, yes, to finish, one last comment, 1 minute for each of you, a message to the CFA members in the region. Let's start with Jason.
So look, I guess a final thought for everybody out there, I know that there is potentially a lot of uncertainty around, some regulatory matters in here, around the path of adoption, around the nature of how this technology is going to iterate and change. I would say that, this is a space that's worth investing in your own education on. That this, hopefully what you've got from today's presentations from all of us, if you take anything away, is that this is a space that's not going away, and its potential to sort of drive change, to deliver new business models and provide growth to investment portfolios really shouldn't be in question anymore. So if you are still looking at it, you should start diving deeper in it now, because it's going to be a worthwhile investment in your ability to service your clients going forward.
Thank you, Jason. Go ahead, Matthew Siegel.
I would say start learning about custody. As institutional investors walk down this path, the inevitable bottleneck is the custody of these assets, because of the phrase, not your keys, not your coin. So, someone has to hold those 14 words, and the institutional investors are going to have to get familiar with how to do that. Otherwise, this ecosystem is not going to grow. And we're seeing the relevance of that in Canada and in Russia over the last couple of weeks. So learn about custody.
And Matthew Hogan.
Great. Just to build on that, I agree with both of those things. And of course, I always get asked, how do I continue my education in this space? There are lots of great resources to read. You can find lists of those. I'm going to make a sort of tangential suggestion, which is to go out and do it at a small scale. Buy some Bitcoin and ETH, see what it feels like in your portfolio. Participate in a DeFi protocol. See what that's like and see what that experience is. Go and buy an NFT. You can use a relatively little amount of money to experience this firsthand. And I think the value of personal experiential learning is just as important as reading that CFA book that David and Luant and I wrote and published. So it's my recommendation to y'all.
Thank you. Go ahead, Inigo, with your last comments.
Thank you, Melvin, Matthew Hogan, Jason Guthrie, and Matthew Siegel for your insights. And thanks also to everyone who participated in our first crypto webinar for Latin America and the Caribbean. I especially want to thank our keynote speakers and our moderator. Their insights were very much appreciated as we all try to navigate the crypto market and get some answers to some of the most pressing questions in this space. So I hope you enjoyed their presentations and the panel discussion that followed. Our goal in these webinars is to provide an objective forum for technical discussions on asset classes, industry trends, and the short and long-term impact of regulatory, fiscal, and monetary policies on financial markets and economies. This was our first webinar for 2022 and is the result of a collaboration amongst 13 CFA societies across Latin America and the Caribbean. Without them coming together, this effort would not be a reality today. Therefore, my sincere congratulations to them and to our volunteers, especially Melvin Escudero and Hugh Miller, for their leadership as chair and vice chair of the Region's Advocacy Council. The good news is that we're planning to do additional webinars this year that will focus on other topics such as data science and artificial intelligence, that's coming up next, climate change, women in investment management, ESG, and many more. Please stay tuned as we work together to bring you high-profile speakers and industry luminaries who are driving change and making decisions in the industry. With that, let me thank you again and have a good rest of your day.